Hello, this is Solomon Davis, Right Side Trader. Today is July 24th, 2023, and this is my I'm doing a weekly thing on how to get started in trading options and all. And today, it's not just how to get started in trading options. There's a lot of things out there, but I'm trying to show you how the money is actually really made and what it's actually cost you to do some of these trades. This is all still going to be very basic. You can just multiply or you can change. And all I'm going to look at is the indexes. I'm not going to get into individual stocks because in my opinion, each stock and each product that you trade has their own, I call it their own personality. They all trade a little bit different. The options are a little bit different. And what I did in the first couple of videos is try to show you some of that stuff, how the strikes are different, how the widths are different, how the delta and thetas are different on those things, and how the bid and ask and how they're actually being traded, the volume, the liquidity, the open interest and all that type of stuff. Those first two videos kind of covered that. And if I need to get in more detail on any of that type of stuff, this is kind of like, all this is really kind of like an introduction. Just let me know, and maybe I'll ask me some questions or post some questions out there, and I'll get around to answering those, even if it's the next weekend, and then maybe I'll cover that again on that weekend. But today I plan on just looking at the basic bullish calls or bullish trades that you can make in the market. When you're new at options, your broker may or may not allow you to trade options because options are very risky and all. So they're only going to allow you to do certain trades with options because they are not going to accept that risk. They're going to make sure you have the cash available to accept that risk. So today, since I'm going to be talking about the bullish trades, the first thing this is all for educational purposes only. No trade recommendations here. We're gonna, like I said, I'm gonna be looking at the indexes and try to explain some things to you guys. Where you should be starting off if you're gonna be doing a bullish trade, you need to know, okay, am I in a bullish market? Is the market, in order for a bullish trade to work, the market needs to be going up. And what is going up? Let's zoom in here on, and you need to, and the other thing that, in my opinion, you need to look at multiple time frames. The whole while through these videos, I'm going to try to stick to a day time frame and a weekly time frame. This is not about day trading. This is more about swing trading and maybe just plain old understanding options. And looking at intraday stuff is not the best place to start at all. It's better to start on the bigger picture, and you have to start with the product that you're going to be trading and make sure you understand that. So, and I'm gonna look at QQQ. If anybody who's been following me, I've been trading QQQ for the longest. It's kind of like my go-to thing, and so that's where I'm gonna start with you guys. So now, a bullish market is a market that's going up. Let me see if I got my little drawing tool here. Let me see if I can find it. I see it. Let me see if I can start it. And it's going to pop up here somewhere. There it is. Boom. And I hope it's not going to be writing too big. You never know. A bull market is it is writing big. It's something that's going up, like what we see here. Let me see if I can change that tip. This is going to be tricky for me. And there it is. That's probably it. Let me see if that writes smaller. Yes, that writes smaller. And Control Z. So, bull market. A bull market is a market that's going up. First of all, I'm looking at something here after the fact. The other thing, in order to be able to identify if the market is going up or going down, for every person that's out there, there's a different way that they probably identify if the market is going up or down. What I like looking at, I use multiple indicators. At least, to me, in my opinion, the candles themselves are an indicator. You can have stochastic, which you see me on if you watch any of my other videos that I like using. I like seeing reversal points using my pivots. That's why I use pivots. They kind of give me reversal points probable reversal points in the market. Also, I like using what is called supply and demand in the market. I would not be going over any of that type of stuff, and this is going to be more focused on options in general and the market in general. So those are other things that you need to learn and you need to know and you need to understand. Here with candles, it's the only indicator that you're actually going to be seeing on my charts. And one of the guys that I know, he called me the candle man, because with candles, I'm gonna put a link. I have put a link in some of my other stuff before to a book that's out there that gives you a good understanding on candles and all. And if you read that book and read some of the other related books and the source of some of those books, you can have a very good understanding of candles. That's why I'll just leave it at that. But let's get back to it. And in general, an uptrend, you want to be looking for candle patterns in the market, candle types in the market, and all to give you an idea if the market is bottoming or topping. And then you want to see continuation, of some of these patterns and some of these patterns that you see. This looks like a market bottoming. And then this candle here is a continuation, is probably the forming of a candle pattern at a bottom, is what you're looking at here. Then you get really confirmation. These two candles here is your confirmation, of this market going up. If you didn't see this at the time, if you follow my videos, a lot of times you hear me saying, "Are we at a bottom?" Or say we have confirmation of a bottom. I believe this thing is getting ready to go up. Nothing goes straight up, as you can see. There was a little pullback here in this area, and then it continued going up, and that's the way the market moved. But for a bullish trade, you need the market going up. Now, the other thing that you're going to need, these are weekly candles that I'm looking at here, you're going to need to give yourself time for your trades to actually work, and that's where a lot of traders mess up at. They do not give their trades enough time. They do not give themselves enough time to be right. So I think that's enough to see, this is what you're going to be looking for in the market. You're going to be at some point in this line here, in this thing going up, at some point you're going to see, bullish patterns. We saw a bullish pattern down here. We actually got a bearish pattern right here, and then we actually really got another bullish pattern right here with confirmation. So again, a lot of times you may not catch the bottom and all, but you will catch a pullback and a continuation of that bullish pattern and all. And on this continuation, this market did go up for quite a few weeks. So that's what you're going to be looking with, and that's why I'm not looking at day stuff. I'm looking at more longer term type stuff, and that's why if you looked at my other video and I say you're going to be buying videos, you're going to be buying option positions if you're buying options positions 90 days or more out. In general, is what I would say you would have to look at, and this is why, because the market goes up usually a whole lot slower then it goes down. Z. So now, let's go ahead and now that I showed you what you're going to be looking for, what the market should look like, if you're thinking about buying a call, or the other bullish position that I'm going to talk about is selling a put. So, buying a call, again, I'm not going to, I just want to show you on the platform how the mechanics of it, not really looking at it to make money on what's happening right now in the market. Okay? And I'm going to show you the mechanics of it also for selling a put. Again, not what's exactly happening in the market at this time. But this is a paper account, and it is a live paper account, so we'll be looking at real live data. So let me jump over to the virtual account. That's all I'm logged into at this time. is not that important. What's the numbers that you're actually looking at here? So let's just put that out of the way so it won't be a distraction and all. And since we're only going to be looking at the index on this particular platform, on the Thinkorswim platform, TD Ameritrade Thinkorswim, uh, get that out of the way so it won't be a distraction. Also, we want to go to the Trade tab. On the Trade tab is where your trades are made and placed. And now I want to show that. So first of all, 90 days or more. How do I know how many days and in 90 days or more, I'm saying 90 days to expiration or more. The plan is not to hold these trades for 90 days. The plan is to hold these trades until you make the money that you expect to make on the trade based on what you see on the charts, and the charts will tell you when the market maybe is reversing or reached a level that it's a high chance that it may reverse, or you've well, yeah. When you place a trade, you're looking at the charts. That's why I started with the charts, and you got to get to the point where I'm placing this trade. I've seen in the past that the market in so many weeks moves so much moves X number of dollars. So if this say move X number of dollars, I should make X number of dollars. So that's the whole thing. So that's why I'm saying I'm not going to be focused on that, on the money. I'm going to be focused more on the mechanics of what I'm looking for. How do I find where's my 90 days or more option that I'm going to be buying on this particular product, or any product that you look out there on this particular platform? This number right here, back to my drawing tool, let's make it a little bit bigger. These are the number of days to expiration here. These numbers here, and I'll go down a little bit past my 90 to let you see. On this product, on QQQ, on some of the closer ones, they have expirations every day of the week. As you go further out, it starts breaking up into weeklies, to quarterlies, and just monthlies and all. So, they have the weeklies are expiring on Friday. These other ones with nothing on them, these are just dailies and all that are expiring. Then you have your quarterlies, and then on the third Friday you have your monthlies and all. So 90 days, back to the 90-day thing. When I say 90 days or more, this is the location that you probably should be trading at. Control, let me do it like this. This is the location where you should start looking at, and all right here. So how do you actually place a trade? I remember when I first started, I think I was able to figure out how to buy, but then I didn't know how to sell. And we're going to go through both sides of the trade right now. Because what I'll do is I'll set my closing trade as soon as I purchase. As soon as my trade executes, I will want to set my closing trade. And I'm going to show you somewhat how to do that. Control Z. Let me do this. Let me show you that. Where's my erase right here. There we go. All right. So we out here 90 days and all. When a lot of times you'll hear me say if I'm buying stuff, I like buying at the money or in the money and all. And I'll buy as far in the money as, a 0.5 delta and all. And I talked about delta before to explain. For every dollar move, I expect my option to move 70 cents and all. So that's why I do that. For every dollar move, if I'm buying something at the money, I'm buying something that I expect for every dollar move to move 57 cents, my at the money option. I might on this particular product go as low as a 0.5 delta and all, and then for every dollar move that I see, I expect to get a 50-cent move and all. And now, if I'm going to be holding this a few days, you know, it can lose as much as 10 cents a day if it's not moving at least 10 cents a day. That's what the theta does to us. So just kind of explain that part again. And the other thing that you want to look at, I'll do a video on that, on volatility. On volatility, you really want volatility to be low. So I have to do another video on volatility, implied volatility, to show you how can you tell if volatility is low. On some platforms, they have a ranking, a 1 to 5 ranking. 1 is low, 5 is high. Some of them have this whole percentage thing. You can, based on this percentage thing, it's actually going from 0% to 100%. Can let you know if it's low or high. But I'm going to actually show you some other stuff to let you see, where you can go once you get used to trading, to see where's that volatility for this particular product. I won't do that now. I just want to go through the mechanics of actually buying something. Okay, and now in order to buy an option, we're going to just buy one right at the money. What I'm doing is just clicking on my ask price. If you never did this before, I know you guys who've done this before, it's not a big deal. But if you never did this before, a lot of times you don't know. And the thing is, get into your paper account and practice this stuff. So I'm going to click here, because again, now my expectation is the market is going to go up. I want to buy a call. This right here on the call side of things. You don't have to buy at the ask. You can buy anywhere between the bid and the ask, or you can actually try to buy below the bid, but you won't get filled. In order to get filled, you buy right at the ask or somewhere in between the bid and the ask. So what's going to come up? Let me change this. It's going to be this ticket, this order entry tool. And on this order entry tool, what we are looking at, delete, we're looking at we buy a single contract, not multiple contracts. It's a buy, the number of contracts I'm looking to buy, which is 1, the symbol that I'm actually buying that contract on, the expiration date of that contract, and the strike that I'm actually buying, and then the type of option that I'm buying. The other thing here that is showing is the price. The price, we have to remember this price is going to be multiplied by 100. So one other thing that we're looking at here is the order type. When it comes to order types, there's market orders, limit orders, stop limit orders, trailing stop orders, trailing stop limit orders, on market close orders, and I don't know what LOC, limit order. That might be a limit order on close. This might be a market order on close, is what these two are. I very seldom use these days. I used to use when I was day trading, I would use this on market close. I would but on QQQ is one of these products that you got 15 minutes after the close to actually close any option trades, which is really kind of nice at times. And then the other thing here that you need to know is the time for the order to execute. Do you want this order if you're using limit orders, and all based on your price. If your price is below the market and you're expecting the market to do a pullback to get you in for your long call, you can set it to good until cancel, and you're waiting for that pullback to actually happen. Exchange, again, just always kind of just leave this 99.9% of the time. You're going to just want to leave this on best, and your broker will give you the best price that's out there at any of these exchanges. So now, once you've got your price set and you got your limit order set, you're doing a day order. It's not a day trade, it's a day order. You know you're buying one contract, you hit this confirm and send button. Confirm and send. It's going to bring up a confirmation ticket for you, and it's going to explain what you are doing. read this. Because again, if you made a mistake, you want to catch it before you actually send it to the market. You want to verify that you are doing just one contract. You are trading QQQ or whatever product you actually happen to be trading. If you want to trade, if you realize you're doing a quarterly option, maybe you didn't want to do a quarterly option, you want to do a weekly option or a monthly option, and you can go back and make those changes now. You're doing a call, the strike that you're actually doing it, and the price that you actually want to have in there. If you realize, oh, I put the wrong price in there, and I didn't want to do that, this thing here kind of gives you some other numbers, these break-even numbers, and all. Kind of get used to these numbers are subtracting, the amount that you're paying from the strike, then all it is, if the market actually starts going against you, what's your break-even point and all that stuff, or your break-even point for the market to actually go up. Because since we brought a 359, you have to add $17 to it, $18 to it. Just rounding. If you add $18 to this price right here, you're going to have 376, which is this number right here. So that's how they come up with that number. Maximum profit, infinity. That's why people like trading options. They think they're going to win a gazillion, they're going to make a win. That's when you start even thinking that, it starts making me think gambling. And that's why you have a plan. It's not gambling. It's probabilities on your side or not on your side. And you're placing your trade based on that. But it makes people get where they think, oh, I can make $1 million on this one trade. It can happen, but not likely. Especially on an index, and that's why they like trading stocks and other things. I'm getting off track again. Actually know your maximum loss. Your maximum losses will not be any more than the money that you spend on this particular contract. And that's where it gets back where the market, your broker tells you have to have $17,000 in your account in order to place this trade. You got to have enough money in your account to place this particular trade. And and I think I'm looking at the wrong. It's going against the wrong account. I'm gonna show you what that looks like too, because it's going against my IRA account that doesn't have that kind of money in it right now. And it has some trades already in it and stuff. So let's switch this over to the margin account. The margin account is okay, and it's going to tell you, how much is coming out of your account, your resulting buying power, and for stock and for options, you see twice as much for stock because in a margin account they give you at least, they double it or 3 times it or 4 times it, all based on the broker that you're with and the type of margin account that you have. We're not going there either. I'm trying to just go over the information that you're seeing here. And then once everything looks okay here, you can just click send. And now, since the market is not open, you will have an order sitting out here. It's a buy order. That's why it says buy. Once this order is actually executed, it will say position and then you would have a position on there. So once you get a position, then you want to set up your closing orders. There are ways to place both of those orders at the same time. We're not going to go there at this time, but I will show you how that is done right now. All you're going to have to do is you can create an opposite order once you have what I'm doing. I'm right-clicking on my position once it turns into a position, and I can say create opposite order. It's going to bring up a ticket and to sell a single one contract QQQ with the correct expiration, with the correct strike, with the correct type, and you're going to make that price whatever you want it to be. Say you want to be able to, because now you're going to be selling this thing somewhere above the price that you actually pay for it. In order for you to make money, you want to be able to buy at a low price and sell at a high price. So what you would do you can set it. Let's say set it for $20. 2000. Uh-oh. Oh. So, and then I usually do is set me a good until cancel. I'll do a confirm and send, and it shows me my max profit. My max profit now, it says $2,000, but I really have to say $2,000 minus the money that I actually paid for this trade, which was $17,000. And so what I'm really going to be making on this trade is about what, 200 and some dollars. Yeah, 200 and some dollars. Yeah, I think it's about right. Maybe next time I'll put a little spreadsheet up where you can see all that. Because the other thing that you should be also doing when you're doing this stuff is documenting your trades and all. So let me see if I do a confirm and send. It also shows you your buying power effect. The thing is, this buying power effect is showing it as though if I was selling a call naked in a margin account, that would be my buying power effect. It's like a couple of times more than what the credit that I'm trying to receive and all. That's just the way it works in margin accounts. It shows the resulting, effect on my account. It deducts some money from my account to help protect the brokers, and they want to make sure that I do have money in my account in order to place this type of trade. But I'm placing this trade right now just to close the order that I expect to get open. You do not do this until you have a position in place. So I'll tell you that right now. But I can do a confirm and send, and now I have both of those orders sitting out there. But right now I'm actually going to close both of these orders. I'm actually going to confirm. I'm going to say cancel, and I can cancel the other one. I can see I have both of them out here at the same time. I just canceled my buy, and I'm going to cancel my sell. And that's how easy it is to cancel on this particular. That's why I'm saying for beginners, this is probably one of the easiest platforms to start on. Things are pretty straightforward. Things are not that easy. They have plenty of training videos on how to use the platform. This is really a nice platform to get started on. And that's about it that I want to show on buying a call and closing that call position. And I hope this is being helpful. Let me see something else here. See if it has it available here. On this custom buy. This custom buy is one of the things that you can do to when you're buying an option, you can buy it with brackets. So when I'm placing my order, say I want to buy that call that I just went over, and this is one way where you can, before the market open or before the market after the market is closed, during closing hours, you can place that trade out there. Say I'll buy it right at wherever it's trading at right now, and I can set my closing order for profit, and I can set my closing order for a stop. And all. That's what we have here. And I have to change each individual one of these to make sure we get it done right. First of all, again, it gets back to the ticket. I'm buying, and I have two cells. One of these cells is for profit, and the other cell is for a stop. And a stop is something to, prevent yourself from losing money on the trade. I don't use these orders on this platform because in the past, I don't know about on this platform or one of the other brokers that I was working with. Sometimes you would have orders out that you will have these type of orders set up, and they'll trigger a sell on you, and all. Because now the market has moved, and you have forgot that you had placed it out there, or you didn't get to it soon enough, before the market actually opened and to make any changes, and you get there after the market has opened, and the market is way below where you was actually stopping at, and it ends up selling something on you. So things like that, I don't know if it happens today. I don't do it today anymore, but that's why it gets, when you're first starting out, place each individual order, or if you're waiting, you place these orders when the market is live and not pre-market or post-market until you get a little bit of experience how to do that. Right now, if I see just give it for the example for educational purposes only. I can set this thing just like what we see right here, right now. I got a $1 stop and a $1 profit on this particular trade. As you can see, I'm trying to get in at 17. I'm trying to get out with a limit order at 18.38. I'm getting out of this thing if it goes $1 lower at 16.38. And I should be able to do a confirm and send and place this thing. And I can adjust these if I want to. Say I want my target to be $2 higher. So I would change that to 19. And I still want to let my stop stay $1 lower, and I should be able to do that. Now, once you do that, it gives you 3 different orders, on that. And it gives you, again, make sure it's one contract, make sure it's the correct correct position, expiration, and call. Make sure your price numbers are correct. But as you can see, what it's going to cost you is still that $1,738 to get into the trade. I don't know why it's showing these 2 different credits like this at 1733, 1733, and this right here. These, again, that's why I said you have to be. I prefer to place these in the live order market and not pre-market, and I gotten where I don't even use these things at all anymore. Anyway, because at one time it seemed like they wasn't really actually working right. But I will show you. This is what it's going to look like. If you find out from your broker or whatever broker you'll be using, it should look something like this. And it's since this is a market order, I think that. Oh, and they changed the wording here. They got a base on here, base -1, base -2, and all. And this is the stop and this is the limit. Again, this looks a little bit different than it looks before, and it's also showing you that it's an order cancel order type thing. And that's the thing. Once the one order, your buy order is executed, you should have these 2 orders sitting out there. And then once one of these orders is actually executed, your stop for loss or your limit order for profit, the other order will be canceled. And they may have it fixed. All I know. I don't know. But that's that. And that's all I really want to show on this one. The next video, since this did get kind of long, I'll do the put side and show you how to do a bullish put sell. But for right now, that's all I'm really going to talk about here on the call side, how to place that order, and a little look at the chart, what the chart should look like when you're trying to place one of these orders. And that's it. This is Solomon, Right Side Trader. Hope this is being helpful. It should be basic stuff, but and I'm not getting into the details. How do you go about selecting what strike? All I'm saying, give yourself right now. I'm gonna tell you, give yourself whatever you think is enough time to be right. And the starting point is 90 days or more, and that's not going to always be the case. Sometimes, starting off, you probably should never go less. And you need still based on the product. You probably should never even trade, options, because again, options are a very tricky thing. That's all I can say. They're not the place to start with. I will give the advice of start. If you're going to start trading with the stock itself. Learn how it moves. Look at the option and paper trade the options along with those trades. Once you start getting successful, you can get where you can double an account. And doubling an account is not that. It is difficult. The difficult part is you. It's us. It's us. If we learn to set up a successful plan, a plan that we have practiced and traded, paper trade to see that it actually works, it becomes and we can stick to that plan, it can be done. Again, that's all I really want to share at this time. This is Solomon, Right Side Trader. Hope this is being helpful, and look out for my next video where I'm going to do the selling of puts on the put side and kind of talk about that. That's it. Hope you guys are having a great day. Hope you guys are having a great weekend, and I'll talk to you next weekend. Have a good one. Bye.